Welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Just a quick reminder, there's a disclaimer at the end of the show that's important for you to listen to. You know, as listeners know, we at the CFTC, we're always trying to learn about the markets we watch and regulate to better understand liquidity, dynamics, and structure. We do this to ensure that these markets we regulate operate efficiently, safely, and fairly for everyone who uses them or is impacted by them. Now, today, we're going to take a look at how the Federal Reserve views recent developments in the U.S. economy, monetary policy, and the markets. And to do this, we have a very special guest, Dallas Federal Reserve President and CEO, Rob Kaplan. Rob, it's great to have you join us today. Welcome.
Thank you, Andy. Good to be here.
Well, before we get to the questions, I just want to say thanks again for inviting me to come down to Dallas for the Dallas and Kansas City Federal Reserve Energy Conference. I learned a lot and made a lot of great connections, so I think the conference was a very big success, so thanks again.
Thank you. We're glad we're here, and we plan to do it every year.
That's fantastic. Lots of great information, great presentations. Let's jump right in and start with the state of the U.S. economy. The FOMC projections are for continued elevated growth in 2018, but projects this to decline in 2019, 2020, and now 2021 down to 1.8%. What are the driving reasons for this anticipated slowing trend, Rob?
So, as you mentioned, we think GDP growth this year is going to be approximately 3%. The reason for the projection of some slowing is the following. We think some part of the jump in GDP growth this year is due to the fiscal stimulus, not just the tax bill, but also the budget bill. Some of that stimulus, as expected, we think will fade in 19 and 20. So then the question is, we know that workforce growth is going to slow in the years ahead because of aging. So GDP is made up of growth in the workforce and growth in productivity. And we've had a good run here in 2017 and 2018 so far where hours worked have jumped. In addition, the unemployment rate keeps dropping, so more people employed. And participation has actually stayed kind of constant in here. We think as we get into 19, we're probably at our limits to how many more hours people can work. And while the unemployment rate will go down, it won't keep going down as fast. You know, we're 3.7, it won't go down as fast. So we're going to get a little less boost from labor force growth. And I mentioned this aging demographics mean that the participation rate, we believe at the Dallas Fed, may actually start to decline over the next few years just because people will inexorably begin more frequently to retire. So then the question is productivity growth. What's it going to be? And the truth is economists are very good at forecasting labor force growth, or pretty good. We're not very good at the Fed at forecasting what productivity growth is going to be. So the question is, will productivity growth jump higher than it's been over the last 10 years and make up for the loss of labor force growth? Now, maybe it may happen because of more CapEx, regulatory reform. But the reason the Fed is projecting, and we're projecting the Dallas Fed, some slowing is we think while there might be improvements in productivity, it won't be enough to offset the slowing in labor force growth. But the truth is we don't know. And so we could be wrong on that, and I think it's important to note that.
I love about you, Rob, to be honest, is your humbleness when it comes to looking at these statistics, because it is so difficult, and there's limits to what we can understand just looking at the data. And I'm going to come back to productivity when we talk about technology just a little bit later in some of the questions. At the energy conference over lunch, you said you like looking at the U6 unemployment rate versus the U3, or the usual unemployment rate the most media outlets focus on. Why do you like the U6, Robin? What does it tell you about job outlook?
So I'm very sensitive, just for your listeners. So in the lingo, U3 is what you normally hear on the news, headline unemployment.
Right.
And we just said that's 3.7, and it sounds like it's a historically low number. But the caution is we know that, setting aside demographics, we know age-appropriate or prime-age workers, we know that their participation rate has been lagging. Then the question is why? And so I tend to look at also people who are discouraged, that have given up looking for a job and therefore don't get counted in the labor force anymore, and people who work part-time that would rather work full-time. That's what U6 captures, and that percentage is closer to approximately 7.5%. Much higher than the 3.7. The problem, while the 7.5 says, gee, we've got more slack, the problem is that 7.5% is below the pre-recession low for that figure. So historically in the United States, you've always had some number of discouraged workers and people who work part-time would like to work full-time. And so that U6 figure tells me, even though it's a higher number, we got a pretty tight labor force. And the other thing that tells me that is all my conversations, which are frequent with businesses and all our surveys, and I see labor shortages and tightness everywhere.
Yeah, I went back and took a look at the spread between the U3 and the U6 prior to the recession hitting in 2007, and we're below that spread where we were back then. So I think that underscores your point here.
That's right. And so this gets to then the question, if I thought we had more slack, or if I'm turned out to be wrong and we've got more slack than I think, that means the economy can grow faster. But if there isn't much labor slack, it means we're not going to get as much boost in the future from growing the pool of employed workers.
Yeah, that's a great point. Well, obviously, this begs the question, then what about wage growth and inflation? If we're in tight labor markets, why haven't we seen those go up significantly?
Yeah, so here's my own view on this one. I believe the cyclical forces are building, meaning tight labor force is leading to, I think, pretty broadly, wage pressures. Now, I see it more pronounced at the low end of the wage cycle, I mean $10 to $15 an hour. And I see it for skilled workers extremely pronounced, and this is why you've got this big skills gap in the United States. You just can't find, small business can't find enough skilled workers, so they're paying up in all sorts of ways, bonuses, you name it, to find them. In the middle is a little more ambiguous. And what do I mean by the middle? $20, $25 an hour with benefits. Those workers, I think it's more mixed in that workers then start to take into account what's the quality of my employer, what happens to this company in the next downturn, do I have promotion opportunities, what are my benefits, and but even there we think there's pressure, just not as much. Now the reason that I think the wage pressure is more muted than we would have seen historically is the structural factors of primarily technology. That is automation, technology replacing workers, which is a powerful trend that's intensifying, and to a lesser extent, globalization. But I think this automation and technology replacing people is causing businesses to say, you know what, I don't need to pay as much. I can invest more in technology, and we'll just have fewer workers for every unit of output, and I think that's creating a little bit of a dampening, and that's why you don't see more wage pressure. And I think it's also, technology is also translating for me as to why you don't see inflation running away from us, because a lot of businesses, even if they have input pressures and costs, can't pass on those costs into higher prices because their competitors, will combat that, and the consumer won't allow them to raise prices.
Well, if you had wage growth, then wouldn't that also, to some extent, for the smaller companies, wouldn't that also put more pressure on them to turn to technology?
Yes, and in fact, it's exactly what's happening, and that almost every business I talk to is saying we need to invest more in technology. Then the second comment they make is we don't have enough scale. We need more scale to afford it. And that's why you're seeing so much merger activity. You're seeing a record level of merger activity. A lot of it is because businesses can't pass on price increases, yet their input costs are going up. They need more scale to invest in technology, and they're deciding that they need to get bigger and maybe merge with others in order to afford a greater investment.
Great point. Let me switch gears a little bit and talk about demographics. And I know the Dallas Fed spent a lot of time on this. Well, how do you view demographics or an aging population? What role is this playing here?
The key role it plays is in the participation rate, in our view, and meaning we know that the participation rate, and that's 16 to 64-year-olds who participate in the workforce, who either have a job or are actively looking for a job, that percentage was basically 66% in '07. It's down to a little less than 63% today, so it's a big deal. The problem is the bulk of the decline, we believe, at the Dallas Fed in our work is demographic. Not all of it, but a bulk of it is due to aging. And the problem is, if we look out over the next 10 years, we think it's just as likely that the participation rate may slip to down closer to 61% from where it is today, because this aging trend is intensifying. Now, there are things we could do to combat it. You could get more women in the workforce. You could have underrepresented groups, improve their employment rate, previously incarcerated people on disability, get them back into the workforce with incentives. And yes, as sensitive as it is, immigration has historically been a key part of workforce growth in this country. And last comment, we think at the Dallas Fed we do a lot of research on immigration and we know it's sensitive, but we do a lot of work on it, and our work indicates the U.S. would be very well served to restructure the way we do immigration and make it more skills-based and employer-based, much like they do in Canada. But we want to caution, if we're going to cut the number of immigrants coming to this country, it has a negative effect on workforce growth, and historically the U.S. has benefited from this as one of many aspects that have helped us grow the workforce.
Well, we've talked about one indicator for the economy and jobs, the U6. So let's talk about another one here, the U.S. stock market. Rob, as you go through your monetary policy toolbox for indicators on the U.S. economy, where does the stock market fit in? Is it a power tool, a tape measure, or something you use to figure out where the studs of the wall are, or how do you come down on this?
So for me, and obviously I've spent my entire life, adult life, in the markets.
Right.
So I even before I came to this job, I'd look at the markets, and I include the debt markets, investment grade, government, high yield, the commodities markets, the stock market. I look at least 2 or 3 hours a day. And here's what I would say: valuation in and of itself is not what I'm watching as much as I'm watching excess debt and other imbalances being created. But to your point on what are the markets telling me, because interest rates have been low for an extended period of time, it stands to reason, and this is what we're seeing, real estate cap rates are lower. Market PEs are higher. So valuation is probably in terms of multiples is at the higher end of historical ranges. And the other thing I would caution in interpreting the market, you've got to remember that in excess of 50% of revenues from the S&P 500 and profits comes from outside the United States. So net exports don't count in U.S. GDP growth. Net imports, don't count in U.S. GDP growth. But for our companies that are operating globally, when they do well globally, like in China, it may not show up in U.S. GDP, but it shows up in S&P earnings. And so the U.S. stock market is not as good an indicator of the health of the U.S. economy as it was, say, 20 years ago, because of the fact that our companies are so global. So I always keep that in mind. And then the last thing I would comment as I look at the Treasury curve intensively, and I actually think most of what the Fed has said about the future path of rates is substantially priced into the short end of the Treasury curve.
Okay. Well, one of the consistent messages I heard down at the energy conference was that no one wanted to predict the price of oil, but everybody said to expect volatility. And I guess given the recent events since that conference, I think, can we safely say this expectation has been met?
Yes. So yes, and I've gone, as you heard, we've gone a step further here at the Dallas Fed. Texas is the largest energy producer in the United States, so we do an enormous amount of work on this and have a substantial team, and we get lots of advice from the industry participants. And we've said the following: not only will there be volatility, but we have to recognize that global supply demand have gone from oversupply leading up to sometime in 2017 to we now think we're in a rough equilibrium, global supply and demand. And the caution is because we're in rough equilibrium and there's not that much spare capacity globally, and there hasn't been that much long-lived investment, we think the world is more heavily reliant on growth in shale to meet increase in demand. And we know, because shale has such a rapid decline curve, there's limits to how much shale can produce. And we've got worker shortages, pipeline shortages, et cetera. So we've cautioned as we move along in the next few years, probably the price risk is to the upside in the market, mainly due to geopolitical issues like we've been seeing recently, whether it's Iran or Saudi Arabia, et cetera. But if you get out beyond the next 3 to 5 years, we've cautioned, unless the dynamics of this market change, we could also see it possible to get into a global undersupply situation. So I guess the punchline is, while there's going to be a lot of volatility and there's lots of things that can change, including with technology and alternatives, we would probably think that price risk is going to be to the upside. And the reason it's worth mentioning that is about 70% of the U.S. economy is the consumer, and to the extent oil prices go up, it's a little bit of a tax on the consumer.
Yeah, it's interesting that you point those things out. We just did a study on the impact of shale on the NYMEX contract and how so much of the volume is going into the front end month, because that's reflective of where the risk is, to the point of shale having those shorter life cycles, right? So
yes.
And I think that's really something that jumped out at us when we took a look at it.
That's interesting.
I'll send that to you. It's interesting. We're talking commodities here a little bit, but I guess for the Federal Reserve and for the Dallas Fed, how important are the risk transfer derivatives markets for your monetary policy? How often do you take a look at these?
This is as it relates in general, or to just commodities?
But both. Let's take it to commodities and then back it out.
So I'll start with commodities. So we look at the forward curve.
Okay.
And try to figure out what that's telling us. Now, it can be kind of confusing. So what's an example? If prices are higher and producers, say in the Permian, have a relatively low break even, they might choose to sell into the out years in order to lock in a spread. Mm-hmm. That would tend to reduce the level of the long end of the curve. On the other hand, if airlines and other industries want to hedge oil prices, they're going to buy the long end of the curve, and that would tend to raise the long end. So we've sort of seen an inverted curve, as you know, mm-hmm. And so we watch it to try to figure out what it means. But some people have concluded that means the market thinks oil prices are going to go down in the future. I'm not sure I buy that. And so, but we look at the curve and derivatives, to your point, and the volumes in those to understand what's going on. And the rest of the financial markets, the reason I look at derivatives is a different reason. I'm worrying about excesses, I mentioned, and imbalances building up. History has shown, in 2008 in particular, that a lot of these excesses may not be apparent, but they get built up in derivative form. So what's an example? People who are short volatility in the stock market, and we saw this in February, if the market goes down, they have to sell, okay? Because you sell a put and it blows up, it gets bigger when markets go down. And in 2008 was a great example with all the credit default swaps. That was tail risk, which wasn't apparent except in an extreme situation. And this is why I'm glad we do stress testing of the big banks now so we can see it. But I do worry about the shadow financial system, non-banks, where we really don't have good stress testing. I don't think we have great visibility.
Yeah, it's certainly something we've spent a lot of time on here, taking a look at that event specifically, and risk parity trades.
Yes, exactly.
And the ETPs that were created out of it. It is a fascinating dynamic. I mean, you can go back to 87 with portfolio insurance, and you had kind of similar dynamics where people said that you were safe, and they had to keep selling into a really fast-moving market down.
So while raising rates, I've been cautious about how fast we move. I've also said one of the benefits of gradually raising rates is it has had the effect of raising market volatility levels a little higher. And to the extent they're a little higher, it wrings a little bit of the excess out of some of these markets.
Well, to that point, let's shift gears again and talk about the U.S. federal debt, because it flows right out of it. And I guess the big question that's being circulated in the markets is the level of the debt, and when will it begin to impact the economy?
Yeah. And so, from hearing me speak and prior to some of the things I've been saying, I'm worried about this. So we mentioned 3 or 4 big structural drivers in the economy. We mentioned demographics. We talked about productivity, education and skill levels lagging. And one of the worries I have structurally is while this recent fiscal stimulus has been a tailwind for economic growth in the United States, and it's helping us right now. If we have to get to the point in the future where we start moderating our debt growth, which we don't know when that point will be, but it's going to come, that actually would be a headwind for economic growth. And my own 2 cents would be, I don't know when the tipping point is, but I think we'd be well served to be finding ways to moderate our debt growth. That could involve, these are controversial topics, entitlement reform, and it also means if we can grow faster, obviously we can pay off this debt faster, and those are important. And I think we're going to have to, in the future, look at more ways to moderate our debt growth. And you want to do it before you have to do it, and which means I think we should be looking at this sooner rather than later.
Well, I guess what flows out of that then is, how does the FOMC view the simultaneous increase in the federal debt issuance with the reduction in the balance sheet where you're putting more securities back into the market?
Yeah, so those are good points. So for me, aging demographics, sluggish productivity, unless we get a positive surprise, the potential of future moderation in debt growth in the United States tells me, and it's one of the reasons why, I think we should be moving very gradually to remove accommodation and raise the Fed funds rate. And this is why I've said I think we should be moving toward a neutral stance, quote unquote, but I'm not convinced at all we should be going beyond that. And I think we should be moving gradually, because the other thing that to this point is the U.S. economy is far more interest rate sensitive than it has been because we've got so much federal government debt. And so I'm very conscious of the fact that higher interest rate means we've got to pay more to service the government debt. And so I think all these factors lead me to say let's be cautious. Now, on the other hand, we've had a balance sheet at the Fed which got up to $4.5 trillion. It was at $800 billion back in 07-08, and we have felt, and I have felt, that we're past the crisis, and it would be wise for the Fed to be working gradually down its balance sheet to some level that's below crisis levels. And having said that, to your point, as we run it down, you would think, all things being equal, it would have some positive impact in raising the longer end of the curve, the 10s and the 30, longer end of the curve. As we reduce liquidity, it may create some upward pressure on rates. So this is why the Fed is doing this very gradually. We're not selling Treasury securities. We're simply letting them run off when they mature. But even doing that when the U.S. government is issuing greater quantities of debt has some impact, and we have to watch it.
Yeah, and I think some of the research that was produced by the Federal Reserve talking about buying at the longer end of the curve, their estimates came up with about 100 basis points to that activity of lowering the long end of the yield curve. So you would imagine that if you're going to reverse that out, you would have, it's not all of it's going to be reversed out. Obviously, we don't know what the terminal, amount of the balance sheet's going to be, but you would expect the long end of the yield curve to react, right?
Yeah, you would expect it. Now, one of the things that's changed since 08, so if you go back to 07, 08, I think these are rough numbers. Global central bank balance sheets were about $4.5 trillion. Today, they're closer to 24 or 25 trillion. This is away from, includes the United States, but most of the growth in central bank balance sheets has been away. Also, pension fund assets have grown. You have aging of societies around the world. So you got, for lots of reasons, you got a lot more liquidity. And this is one of the things that will make it, I think, a little bit easier, in my view, for the Fed to keep running down its balance sheet without as materially as it would have 10 years ago affecting the level of rates at the long end. It's having an effect, but it might be more muted given there's so much global liquidity right now. Right.
Yeah, those are great points, especially in the pension stuff. I think, obviously, that flows right out of the demographics. So, all right, before I let you get back to work, I do want to briefly talk about the digitization of the economy and technology.
Yeah.
Rob, how are these forces changing and shaping the way that companies operate? I mean, you speak to a lot of businesses, almost like 3 or 4 a day, I think, personally. So I'd love to hear your thoughts on that.
So I would say it's unusual to talk to any business, large or small, or medium size, that's not actively thinking about how to use technology to compete, because otherwise, if they don't do it, they're going to get disrupted by somebody who is. And it may not be a technology company. It may be a more normal kind of company, industrial company, that's using technology to enable their business. And this is, you go through every single industry, and I could give you a story about how it's happening to almost every single industry that I can think of, including higher education, which most people assume is not happening there. It is happening there. And so what companies are doing as a result is they're lamenting they have less pricing power. And as we talked earlier, they're investing even more in technology to get out ahead of this. And by the punchline is, I'm pretty confident companies will do a superb job in adapting to this trend, and we're already seeing that. The part of the economy that I think isn't adapting as well is the labor force and our education system. That's the part that worries me, in that companies are moving at breakneck speed to adapt to this. In order to be successful in the future, I think education levels are going to matter much, much more. So if you have a college education today or better, all the studies show you got a very low unemployment rate and you're very likely to participate in the workforce. And technology may actually improve your productivity. If, on the other hand, you're one of 46 million high school workers in this country, or high school or less educated, you're likely finding your job restructured or eliminated over time as a result of technology. And unless you got a skill or you get retrained, you may struggle to adapt to this. You'll find another job in this job market, but you may do it at a lower income level than the one you left and lower productivity. And so what we've been saying at the Dallas Fed is I think it's a national priority, pre-K, better secondary education, certainly better skills training. All those activities will give us a more adaptable workforce, and we'll get more benefits from this technology revolution that's going on. My fear is we are lagging other countries in the world in improving our educational system to keep up with this trend in technology. And I think this needs to be a priority. There's great benefits to the economy and to the citizens from technology unless we don't have adaptable enough workforce. And I think at the moment we're lagging in this area.
Okay, President and CEO of the Dallas Federal Reserve, Rob Kaplan, thanks for coming on the show today.
Thank you, Andy. Good to talk to you, sir.
That's a wrap for the show this week. Remember, you can get access to all the shows we do here by either going to our website at cftc.gov or by getting out your phone and clicking on the podcast app and typing in CFTC Talks. Click subscribe if you want to get them every week. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. Thanks for listening. This has been CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.